Hello, and welcome to Trading 5 Talents. Today's video, we're going to be talking about selling in-the-money calls. But before we begin, I just want to say I'm not a financial advisor. This is not financial advice. This content is for educational and entertainment purposes only. Any trades I mention are not trade recommendations, but either an example trade or a past trade that I've made. So please don't enter into any trades that you see here. Now, let's get into the video regarding in-the-money calls. So let's look at selling calls in general. So these are covered calls, and we use this here at Trading 5 Talents as part of the wheel strategy. If you want more information about the wheel strategy, then there's a video link in the description all about how that strategy works, as well as a separate video just on covered calls. So when we sell our covered calls, remember we are using our shares as collateral. For every call option that you sell, you have to own 100 shares of the underlying asset. In our video regarding covered calls and how I typically sell calls is we generally sell call options at strike prices that are at or above the cost basis of our shares. So these are at the money calls strikes, or these are out of the money calls that we're selling. For example, if you bought 100 shares at $10 a piece, then you would be selling an at the money call at $10 strike price, or out of the money call, let's say a $10.50 strike price. That's typically what we have been doing and have been going over in the covered call strategy of this wheel trading strategy. However, in this video, we're going to be looking at selling in the money calls instead. Now, for in the money calls, the strike is below your cost basis for your shares. Now, when you sell these calls, and they get exercised, that is, they go to expiration, they expire in the money, you will have a capital loss. Now, capital loss is the exact opposite of capital gains. In capital gains, you're selling your shares at a higher price than you bought them for a profit. That's capital gains. But if you are selling your shares at a lower price than you bought them, now you're selling at a loss. So that's referred to as a capital loss. However, this strategy can still be profitable in that you can have a net gain. The reason is because the premium that you're getting from selling the option is actually greater than the capital loss than you would be sustaining on your shares. So let's look at it in this manner. So what we have here in this arrow going from left to right is basically the sentiment that you would have on the stock itself. So over in red, you have a very strong bearish opinion. You believe that the stock is probably going to be going down pretty significantly. In the middle, it's neutral. The stock may or may not move, or at least it's not going to move too much. And then on the right in green, you're very bullish about that particular stock. You believe that it's really going to increase. All right, so let's look at how some of these option trading strategies play out. If you have a long put, that is, you purchase a put option, your outlook is very strong bearish. It's either bearish to strong bearish. You believe that that underlying asset, that stock, is going to decrease in value. That's why you bought or went long on puts. So the put value increases as the underlying asset value decreases. So for more information about just calls and puts in general, then there's a link in the video description regarding options and how they work. All right, so you got a bearish to strong bearish outlook, you would long a put. Now, on the other side, you would go long on a call if you had a bullish to very strong bullish outlook. And you can see that both of these have this ascending wedge because the profit potential is very large, almost infinite, if that particular underlying asset goes in the direction that you're saying it's going to go in, or you think it's going to go in. So if you're buying a call and that stock keeps increasing and increasing, then your call value is going to increase and increase. That's why you can have unlimited profit potential there. All right, but you have to be very good with your predictions as to where the stock is going to move in order for you to make your money on these long puts and long calls. Now, here at Trading 5 Talents, we run the wheel strategy. So this is an options trading strategy in which we sell puts and we sell calls. So we're selling options, therefore we're short on a put or we're short on a call. So here is our short out of the money put. This is our cash secured put. So there's again a video on cash secured puts down in the description, so you can check that out if you want more information. But basically our outlook here is neutral to very bullish. So we believe when we sell the split, we believe that the underlying asset or the stock is going to stay above a certain strike price. So it can stay neutral, it can remain unchanged, or it can increase so long as it doesn't go below the strike price, and we would profit. Now this is a locked-in profit. This is why we don't have an ascending wedge in this particular graphic. It's just a rectangle. So you already know your profit at the beginning of the trade. So this is the premium that you receive when you put this trade on. If you have 100 shares, you can sell a call, and that's what this would be. So we would sell or short an at the money or out of the money call. So this would be our covered call strategy. And so both of these together would comprise the wheel strategy. And in the covered call side, we have a neutral to a bearish outlook on that particular stock. So long as the stock stays below that strike price, we will profit on that particular option. So you can see that if you're long options, you have to be very specific in what your outlook is, and you have to be very accurate in what your outlook is. If you short options or sell options, then you have a little bit more leeway as to when you're going to be profitable or not. So the purpose of this video is to take a look at in the money call options or shorting in the money call options, because you're going to see here, this is why I think it's going to increase your chance of profit, because now you can be strong bull, normal bullish, neutral, or even slightly bearish and still profit from your options position. That is, it comprises a wider spectrum of profitability on this gradient of profit. So let's look to see how that would be done. All right, so here is the screenshot of the options chain for FUBO, and you can see at the time that I took this screenshot, it was 12 days until expiration for the September 24th option. So we're looking about, in between 1 and 2 weeks of time still left in this option, and you can see that the current price for this stock is $30.15. So for this example and this setup, what you would do is you would purchase 100 shares of FUBO at the current share price, which is $30.15. So that would cost you $3,015. So 100 shares at the strike or at the share price. Now, what you would normally do, or at least many people might do, is that they would actually sell the $31 strike price, because this is at or above the current cost basis. Your cost basis was $30.15. So they'd sell the next strike up, and you can see the premium is $1.12 per share. So you would receive $112 in premium. However, what we're looking at is we're looking at the in the money options, and those are these right here, this $30, the $29, and $28. So if you did this, so if you bought 100 shares at $30.15 and you sold the $30 strike price, look at your premiums. So $156, $206, $266, depending on how far down you go on this options chain. Why would we want to do this? Well, here's the reason. Let me put this into a different table here, and you can see. So here's the profit and loss for selling in the money calls on FUBO. So if we purchase our 100 shares at $30.15 and we sell this out of the money, okay, this out of the money strike price, you can see that that call received $112 per share, and that's the premium that we would receive from selling this call. And when those when those shares got called away, let's say it expired above $31, then we would receive 85 cents in capital gains from the stock. That's $31 we sold the shares at, and we bought the shares at $30.15, so 85 cents per share. Okay, our total then, this 112 plus the 85 is $1.97 per share. So that is $197 we would get potentially in profit. And that's if the shares expired above $31. Now let's look at these in the money call options. Okay, we're still buying the shares at $30.15 per share, but now let's look at this one. We sell the $30 strike price. This is in the money. So we receive the $1.56 in premium. So if these shares close at $30 or above, then we have to sell our shares at $30. We purchased them for $30.15, but now we have to sell them at $30. So we're going to lose $15. This is our capital loss here on the stock. We gained $1.56, but we lost 15 cents per share. Our total is $1.41. Right? Now let's look at the next strike price. We sell the $29 strike price, again, an in-the-money call. And from that call option, we get $2.06 premium. However, if the share price stays above $29, we're going to be forced to sell our shares at $29. That's the idea of the covered call. So we're going to lose $1.15 on our stock. This is our capital loss. So we bought them at $30.15. Now we have to sell them at $29. That's $1.15 loss. However, because the premium was larger than our capital loss, we still gained 91 cents per share, or $91. Even here at the $28 strike price, we gain this $2.66 premium. We lose $2.15 in our capital loss, but we still gain overall 51 cents per share, or $51. Now, why I think this strategy is really unique and really can expand the range of our predictions is that all this stock has to do, if we're looking at this $28, all this stock has to do is stay above $28. And we bought it at $30.15. Therefore, if this stock increases, we make money. We still keep the $51. If this stock stays exactly where we bought it at, $30.15, we still make $51. If this stock goes down by $1 or so, goes down to $29, we still make the $51. This stock can go all the way down to $28 and we still make $51. So if the stock increases, if the stock stays neutral, or if the stock goes down slightly, we can still make a consistent profit by selling in the money calls. So there's not many strategies that I found that allow this type of profit. They're not great profits. They're not, astronomical gains, but they're consistent profits. And you don't have to be 100% right in your prediction of where that stock is going to go. So this is why I consider this a very strong strategy for option sellers and is a great way to sell covered calls in using the wheel strategy. So if you have any questions about this topic, just leave a comment down below and I'll answer it as quickly as possible. And in the meantime, if you want to learn more about the wheel strategy and view my progress on how I'm using it for lifestyle trading, then click on the subscribe button and turn on the notifications so you can catch all the updates. Until next time, trade wisely and take care.